This presentation is going to look at the relationship between national income and national output. It's going to show that national income is actually identical to national output, and that these two phrases are just two ways of saying exactly the same thing. To show this, let's look at the production of a can of Coca-Cola. Now, in order to produce this can of Coke, we need to use factors of production, such as land, labor, capital, and enterprise. Now, each of these factors of production has to be paid for. Now, imagine that the natural resources or land that we use in every can of Coke cost 10p. Let's imagine that the labor costs 30p in each can of Coke. Let's imagine that the capital, whose payment is interest, is 15p. And let's imagine that entrepreneurs, who are paid by receiving profit, get 5p per can of Coke. Now let's look at the total value of the factors of production that were used in the making of this can of Coke. Well, we have 10p of land, 30p to pay for the labor, which is wages, another 15p to pay for the interest, which is the payment on capital, and another 5p to pay for the profit, which is the reward to entrepreneurs. So altogether we have 60p, and 60p is the total income earned by the owners of the factors of production that went into the production of this can of Coke. But 60p is also the value of the can of Coke. It is the value of the output, in other words. So what this example shows is that the total income earned in the production of one product is also the value of that product. And if we expand this to the national level, what we can see is that national income, that is the income earned by all factors of production used in the economy in 1 year, is equal to the value of the output produced by the economy in 1 year. And the letter that we use to symbolize both of these things is Y, the letter Y, which stands for both national income and the value of output. So we have really shown that the concept of national income and national output, or value of output, is exactly the same thing. And we can therefore show both of these concepts by the same symbol, which is the letter Y. Having shown this, however, we now have to turn to a slight difficulty when it comes to measuring the value of national output. And this difficulty can be seen best if we take quite a complicated product, something a bit more complicated than a can of Coke. Let's take the production of a car. Now, as we know, cars use many components and many materials. And we can say that cars are produced in what we can call a value chain. So to produce a car, we have to go through several stages of production. For example, we can say that we can start with a metal, such as iron, but iron in the ground, which is called iron ore, has to be extracted and turned into a slab of usable iron. This is then converted to steel, which we will say is the main constituent or input into the making of a car. So let's say that the steel alone is converted directly into a car. I know this is a simplification, but it serves our purpose. But the car, as it leaves the factory, is not the final product, as it were, because it then goes to a car dealer who does things to it, such as polishes it, puts it in a nice environment for consumers to look at, and also puts a price on it. And it is this car, the car which is in the car dealership, that is finally bought by the consumer. So what we can see is that the car proceeds through many stages of production, and it proceeds along a value chain. Now, at each stage of the value chain, value is added. So let's start with the iron ore, which is in the ground and worth absolutely nothing, because it can't be used in that state. Once the iron is taken out of the ground, its value may rise to £1,000. This may be the value which the iron company sells the iron for to the steel manufacturer. The steel manufacturer may sell the finished product of the steel manufacturer, which is steel, for £5,000. Now what we can see is that between the iron and the steel, £4,000 of value has been added, and between the iron ore and the iron, £1,000 of value was added, because the iron ore was worth nothing, but the iron was worth £1,000. Going further in our value added chain, the steel is converted into a car, which may be sold by the car manufacturer for £20,000. Now here we can see that £15,000 of value has been added. And once the car gets to the car dealer, the final price put on the car by the car dealer may be £24,000, which means that another £4,000 of value has been added. Now, we can see that the sum of all the value added is the same as the final price of the car we buy, in other words, £24,000. So 1,000 plus 4,000 plus 15,000 plus another 4,000 gives us £24,000. And this is the value of what we call the final product. So we can say that the value of the final product is the sum of all the value added at each stage of the production chain. It is this final product which counts as the output of the economy. When we look at the other products that were produced in the value chain, such as iron, steel, and the car as it left the factory, these are all called intermediate goods. We do not count their value when we measure the total value of output in an economy. So to measure the value of national output, we measure the value of final goods only. We ignore intermediate goods. And we ignore them because if we counted the value of the intermediate goods, we would be engaging in something called double counting. We would actually be counting things twice. And we can see this by looking at the value of all the intermediate goods again. The iron is worth 1,000, the steel 5,000, the car as it leaves the factory 20,000, but the car that we buy, which is the car in the showroom, is priced at 24,000. Now, as we've said before, the value of the output of the economy is just £24,000. It is not the sum of all the values of all the intermediate goods plus the final good. If we added up all of these numbers, we would get 1,000 plus 5,000 plus 20,000 plus 24,000, which would give us the figure of £50,000. Now, £50,000 is not the final output or the value of the final output of this example. The value of the final output is the value of the final good, which is £24,000. If we count all the intermediate goods, we will actually be counting their value twice, because all the intermediate goods end up in the final good. So therefore, in order to measure national output, the value of national output, we must measure the value of final goods produced in an economy and ignore intermediate goods. So let's wrap up by looking at what we have discovered in this presentation. The first thing we have seen is that national income is identical to national output, or the value of national output. And both of these things can be symbolized by the letter Y. The second thing we have seen is that in measuring the value of national output in the economy, we must ignore all intermediate goods. There are many intermediate goods that form part of what we call the final goods. But we ignore the intermediate goods and their value and only look at the value of what we call final goods. So the definition of a final good is the good that is purchased by the end user. So a good which is purchased by someone who intends to use the good, rather than trying to use the good to make something else or to add value to it, is the definition of a final good. Now that end user can be a person, such as when I go to the Apple Store and buy an iPad, I am the end user, and the iPad is a final good. Or the end user can be a business, such as when a business buys a factory machine. That factory machine is also the final good because it's going to be used by the business. It's not going to be transformed in any way and sold on. So by measuring the value of final goods, we measure the value of output in an economy in 1 year. And that output is the same as the national income in that year.